to the SL Advisors webinar, Iran War Energy Update. Appreciate everybody being on. We're going to start on time and get right into this. First of all, we will be making forecasts and forward-looking statements which we think are right, but we might be wrong. And everything that we say is based on what we believe to be true, but they're opinions. So at your own risk. If you want to ask a question, you should see a chat box on your GoToWebinar login. So just type in the question. And so let's start with this. I think that Venture Global and possibly Cheniere, and I only say possibly because Venture Global's got such an in-your-face approach to business, but this is going in a marketing slide, right? Because that Ras Laffan facility there in Qatar, that is the world's biggest LNG export terminal, and it closed on Monday. And the best information that the Qataris have put out is going to be weeks and maybe months before it reopens. And so Qatar has a long track record of reliability in terms of supply. They're about a fifth of the world's LNG trade. Now, LNG is only about 14% of global gas consumption. Most of the gas that consumed doesn't move by LNG. It goes through pipelines or is used locally where it's produced. So you've got a fifth of 14%. It's less than 3% of the world's natural gas consumption. And yet gas prices overseas, not in the US, but gas prices overseas have skyrocketed. And it just shows what a disruption that's going to be. And I guess one of the things that Henry and I really think, and I know many of you know, we have a bias towards natural gas for many reasons. We love the data center power demand story. We love the LNG export story. Gas is hard to move, so the infrastructure requires longer term contracts for certainty. I mean, with an LNG export terminal, there's not much else to do apart from export LNG. So 20-year contracts are not uncommon in that industry. So we have a gas overweight, and particularly we have an overweight towards LNG exports. We have over a quarter of our investment exposure in LNG export companies. And when you sign in 20-year contracts, you want to know that the gas is going to get to you reliably throughout that 20 years. And I think it's going to be really hard for Qatar to come back from this because they're in a dangerous neighborhood. And who knows over a 20-year period of time what's likely to happen. What they can't change is the proximity to Iran and in fact being in a dangerous area generally and sort of any sort of exposure to that. So we think this is a game changer for the LNG export companies. This is what's happened in the futures market since last Friday when hostilities broke out. And those are the three main prices for natural gas. Natural gas prices vary globally much more than oil. As I'm sure many of you know, oil is comparatively easy to move. So if there's a price discrepancy between 2 points, the cost of shipping and storing oil is what's going to close that gap up. Gas is very hard to move. First of all, it has to be liquefied to put on a tanker, and there's a finite amount of liquefaction capacity. The Asian and European benchmarks for LNG are routinely much higher than the US, but you can see on the Monday after hostilities broke out, they moved up very sharply. So you've got natural gas in the US around $3. It was around $10 to $11 in Asia and Europe. And that spread is more than sufficient to induce LNG exports from the US to those regions. And we are doing that. And capacity is growing every year. But the price spike here shows that we don't have the ability to export much more. We can export a little bit more, but not a whole lot more. Venture Global has been very strong. Venture Global tends to keep a little bit more uncommitted liquefaction capacity. So typically, they'll contract out most of their liquefaction capacity on long-term contracts, but they keep some back. And those of you who follow Venture Global will know famously when Russia invaded Ukraine, they took advantage of the contracts that they had to use their own liquefaction capacity rather than deliver to customers and take advantage of very high prices. And there's some expectation, not that they'll be running into contract arguments, but that they'll be able to take advantage of high prices again. Now, Cheniere, to a lesser degree, they tend to be more conservatively run. They tend to keep more of their liquefaction capacity contracted out. But I think what the market is not doing is it's not pricing in the long-term benefit for these LNG export companies. I think the rally you've seen in the LNG names is based on that potential windfall gain right now, because European and Asian prices have moved up so sharply. I don't really think the market is focused so much on the long-term attraction that this creates for them, competing with Qatar as a safe place from which to buy. And so we think there's certainly more to go. The sector's had a great run this year, before what happened in Iran. And I think this really just puts it in a great place. So Mike Semblest is the chief strategist at JP Morgan in asset management, and a super smart guy. And I knew him when I worked at JP Morgan. I have tremendous respect for Mike, and I hope you all read the annual energy outlook. It's the 16th one that they just put out recently. And there's a couple of slides I put in here because I think the LNG market suffered under fears of excess capacity over the last year or so. And the natural gas theme that we focus on in our investment strategies worked really well in 2024, not so well last year because it wasn't a new story. And you also had more and more analysts saying, oh, there's going to be all this excess capacity. And you can see on this chart, the sort of, I guess it's a dark green line, LNG export capacity rising in the years ahead faster than import capacity. So what happens is you chill gas, it gets liquefied, put on a tanker. When it gets to the other end, it has to be regasified. So the regasification reverses the liquefaction. So you need both, one at each end of the route. And so regasification capacity is growing. That means demand's growing, but liquefaction capacity is growing more. And that's what Mike shows in this chart. And therefore thinks LNG export tunnels will run at a lower utilization. So there's a couple of things here. One of the issues we think is that they're missing that LNG export terminals generally pre-sell almost all of their liquefaction capability. Cheniere has 95% of their capacity pre-sold through 2035, so over the next 9 years. So they don't have a lot of exposure to that. If there is exposure from too much LNG, it's going to be the people on the other side of those deals, and they are almost all of them investment grade companies, so pretty low credit risk. So if there's too much LNG out there, it's going to be the people who are buying it from Cheniere, not Cheniere, who are going to be struggling with that. But the other thing I think this is missing, and to be fair, of course, this news is in the last week, Qatar is now, I think, going to be perceived as a more risky supplier. And in fact, Qatar is one of the sources of this increased LNG export capacity. And there's some question about even if they'll continue the expansion plans that they had on the same time frame. And of course, there's news developing every day. And so I think the LNG oversupply argument was a weak one and just became weaker, in the past several days. This just shows how it's growing. And the world's just going to use more LNG. Companies are lining up to be buying more, but they're lining up to be selling more as well. And you can see here the Middle East, which is really Qatar. Big part of the growth in capacity here in the out years. Obviously, North America is the biggest source of growth, but Qatar as well. Maybe not. Maybe won't be as much. Maybe they won't get such good terms. That should be easier for the US companies to get better terms. So we have a couple perspectives to share. We just want to really focus on the things where we might have an insight. One is that we think this is very positive for US LNG export terminals, and also the companies that supply them, Williams, Energy Transfer, companies that move natural gas to the Gulf Coast and other areas of the US where we export. We think it's good for them. It also seems to us that the risk of longer than expected disruption to shipments through the Persian Gulf is high. And that's because the US will take out Iran's missile capability. By all accounts, is only a few days away from doing that. But drones represent a real sort of asymmetric form of almost guerrilla warfare. I mean, you can launch a drone from somebody's backyard, and if you go back, we go back to the map here, Iran borders the Persian Gulf all the way along there. I mean, that's a very large area. And I think it's going to be very challenging for the US to really take out drones as a sort of a nuisance threat. I don't think they're going to be a huge military threat, but you don't have to hit your target with many drones. They're very cheap. You hit less than 1% of the time. The disruption that's going to cause to ships and also to fixed assets like liquefaction terminals is significant. And so we think that this could go on longer than perhaps people think. And I think that's one of the reasons oil is up so much today, because the market has come into that realization. Probably takes a truce, a real ceasefire, for that to stop. And of course, Trump came out earlier today and he just wants unconditional surrender. So our perspective is the natural gas story, always a great story. I think for the last, really for the last year, it's been moving with investor appetites for growth stocks. I mean, and I've written about that in the blog, and some of you may have seen this recently, but energy is almost always the least correlated of the 11 S&P sectors with the market. It's become more so, and I think what you've seen is when our sector's been weak, it's because everybody was into growth stocks and the AI story. And I think that was the case last year. And as that has started to turn around, it's also turned out to be the case. So I feel sometimes like, you know, the best explanation for what's happened to midstream has been, well, look at what's happened in growth stocks. And in February, out of 19 trading days, only on 7 days did midstream and the S&P move in the same direction. And that, of course, was before the attack on Iran anyway. That was just simply rapid sector rotation back and forth, back and forth. And this week, we'll probably have 5 days out of 5 where we've moved opposite directions. So that has really been what's been driving things up until last week. But I think the positive story for US natural gas never changed. That's a big overweight for us. I think the LNG exporters are in a terrific position after this week, and we're there, and we're invested in it, and we think that's the right place to be. And we think there's a lot, it's not fully, I don't think it's even close to recognized by the market, the long-term positive outlook for these companies in terms of being a safe supplier. So that's really what we wanted to make the point on here. And I'm going to just turn over Henry, my partner. And Henry, what do you want to add to any of that, or perspectives that you'd like to give as well?
Yes, I think that's a great overview. With Qatar Energies, you know, that's 80 million tons per annum of operating capacity on a global market that's 430 million tons per annum in 2025. So a little less than 20% of the global market. And what's very interesting to us is that, you know, 80% of their customers are in Asia. Their contracts are different from US contracts in which they're often oil linked. So, you know, you get a bit of a double whammy where if something happens with the supply, not only do you not get your LNG, but LNG you may get is, you know, the price is highly correlated with an increasing price of oil in the same choke point. And so I think this is a massive turn in sentiment where Qatar has been seen as one of the most reliable and dependable suppliers of LNG in the world. And you know, they're one of the largest. It's the US, Australia, and Qatar. And they were expanding. You know, they had plans for 60 million tons per annum of expansion in the North Field, all of which is at Ras Laffan in the same area. And so even if they decided tomorrow to bring it back online, it's going to take weeks. And of course, a ceasefire announced today, there's going to be trust issues before you'd even give the go ahead to bring the facility back online. But when do construction crews come back in? And so suddenly, if this 60 million tons is delayed, you know, the first of it's expected to start coming online the end of this year, which has caused a lot of the pundits to forecast a supply glut in the future. Then that can be pushed back at you know, much longer than I think people may realize right now. So all that signals is, you have supply risk now with Qatar. And Qatar is, for all intents and purposes, the only other growth engine of global LNG besides the U.S. And then the U.S., is going to add over 100 million tons per annum over the next 5 years. So a huge amount. And this is contracted. The U.S. contracted 40 million tons last year. So there's a lot of demand. It's harder, I think, for more macro analysts to see the demand. It's easy to see the supply because it takes 4 years to build these LNG facilities, and so everyone can pencil in when the supply will be online. But it's harder for them to see the demand. And regas capacity worldwide is over twice that of what export capacity is, because you need gas at different times and different seasons for different uses. So I think, structurally looking long term, the world is going to look towards the U.S. providers, where you have, low cost gas. Henry Hub, you can look at it still. It's $3 plus today, not having having a much more muted response to this than TTF or JKM or European or Asian prices. And so what you can see is, you can look for a reliable, low cost supplier that you can depend on to get your supplies. And so I think there's this real focus on the quality and dependability of the U.S. that the market hasn't yet recognized or appreciated in these infrastructure companies. You have companies like Cheniere, you trades at 10% cash flow yields. That's a huge discount to the market when you have 17 years of contract. As Simon was saying, 95% contracted out. You can pencil out exactly the minimum amount they're going to make for almost the next 20 years in cash flows, and then the optionality of high prices is all theirs. It's one-way asymmetry. So I think that's great, but I don't want to ignore the NGL story as well, where a lot of these liquefied natural gases pass through the Strait of Hormuz as well. That's your propane and your butane and your naphtha that feed the petrochemical industry. And the largest exporters of these NGLs is the U.S. Energy Transfer is larger than any other country as a pure exporter of NGLs. And so that's, these midstream companies, Energy Transfer, Targa, Enterprise. The U.S. is an absolutely enormous supplier to the petrochemical industry worldwide from these NGLs that the midstream companies, they process, they fractionate, and they move them across their docks to world markets. So I think that's just another huge benefit, for U.S. exporters in that regard, which I think is often missed by the market, which is very crude oil focused.
So that's great. So we got some questions coming in. So oil's up $8. WTI is at 87. I see Brent's at 93, closing on $100. I got one question here. With the price of oil up, could Trump impose export constraints to try and lower prices here? So the US, of course, we all read is energy independent. I had one journalist actually ask me today, how come if we're energy independent, how come the price is going up here as well? Obviously, just because we're energy independent doesn't mean we're immune to prices. And the oil that's here is generally owned by private entities who want to maximize their profits. And so they're going to sell it overseas if the prices here don't go up. But we used to have export constraints on oil. You weren't allowed to export US oil until, I don't know what it was, 7 or 8 years ago. What do you think about that, Henry? What are the odds of Trump imposing export constraints on oil to try and keep prices down here? And what would happen if he did?
I see it as much less likely. I don't think it's an easy fix for it. The easier one is you release from the Strategic Petroleum Reserve of the U.S. And of other global reserves, right? China's been building theirs, and you can release from that to ease prices. So I don't think that would be the first tool used. It's also the U.S. We do have refineries set up to run heavier oils, which we're more efficient at doing. We produce a lot of very light oil. We have imports of over 6 million barrels a day of crude oil, and then we export 4 million barrels. And our imports are largely from Canada, which is forced. Almost all the Canadian pipes are pointed to the U.S. So that's kind of forced imports that are coming anyway. So there's plenty of physical supply for the U.S. But markets have a way of figuring themselves out without that intervention. And so I think it's unlikely. And if it did happen, though, it would have, if anything, an outsized effect on international prices, which again would lift, oil-linked LNG prices, would link LPG prices as well, and really all energy costs. And it's just an inefficiency to the system of, where's the most efficient refinery to process a certain grade of oil.
Yeah, so less likely. Okay, here's another question. Do we think this changes the CapEx plans for US energy companies?
I mean, the US infrastructure companies are very disciplined about this. So, you put CapEx to work once you have contracted a sufficient amount to make your minimal required economic return. So, that takes time, but yeah, I think it's what this is going to demonstrate is if you want a reliable supplier, and energy is, natural gas and oil and natural gas liquids are the lifeblood of the world. The world runs on carbon, and so I think it's very positive for the U.S. sector longer term, and I would expect, in time to see, increased CapEx in LNG facilities, more of those get FID'd when they have enough contracts, increased, and we have a very large build out of exports of NGLs that should increase. But I think it's going to be a demand driven response, I think.
What about upstream? Do you think we're going to see shale drillers increase their plans?
Shale drillers won't respond too much to short-term spot prices, right? Because they like to hedge a lot on the forward curve. So the high prices in the short term can be sort of a cash bonanza for some of the companies that aren't as hedged. But it still takes 6 to 9 months at least to bring on shale wells, particularly in pad drilling. So I think you'll see a more muted response. You'll have to kind of, I think, they'll wait and see how it plays out longer term before rushing to raise rigs.
Okay. And here's another one. What about US LNG exports are going to grow? We know that. Does this likely alter, presumably increase? Does this change the likely growth path of US LNG exports? I mean, it takes a long time to build an LNG export terminal. There's pretty good visibility about what's going to be built over the next several years. But do you think that could increase from where it is?
Absolutely. I absolutely think so. I think you're going to see a lot more demand. The U.S. model is proving itself out for LNG based on Henry Hub, based on long-term contracts that are guaranteed. It's a reliable supply. You're looking at those that didn't contract or contracted with Qatar, right, in Asia. So if you have these contracts with U.S. providers, you're paying, Henry Hub plus a tolling fee, and not much has changed for you. And if you're buying on the spot market, you might be bankrupt in a few months. And so it's just incredibly, I think, irresponsible for these companies, global companies or utilities that rely on energy and really need it to kind of keep this exposure. And generally speaking, about 2/3 of Asian demand is contracted out. Now, where they've got themselves in trouble is thinking that Qatar was a reliable supplier, right? And so that, you can excuse to some degree. But if you look at Europe, they have 1/3 of their demand contracted out. Completely irresponsible. And, they haven't wanted to, they've called it a transition off natural gas or off the fuels for forever, depend on Russian gas. We saw how that went in 2022. and then shifting to LNG as a kind of temporary, this constant temporary stopgap versus signing long-term contracts for the gas that they really need. And so they've shot themselves in the foot again. And you see, going into this crisis, they're back, below 5-year averages, towards the low end of 5-year storage levels, under 30% coming out of the winter.
It's unbelievable. I mean, the Europeans, that is home to the world's dumbest energy policies, is Europe. I mean, they should understand the world turned to energy security rather than the energy transition following the invasion of Ukraine. And yet they've been behaving as if that didn't happen. And now here they are once again caught in a tough spot with a shortage of LNG supplies and the world's highest electricity prices. I mean, that's part of the reason why Europe is slowly deindustrializing. And it's just an amazing thing to watch, how far left policies on energy are really slowing growth and making it a much less investable region. From very, very bad decisions. And thankfully, the US is not going there. And we don't invest in the energy sector because we think there's going to be global conflict. But it is true that when you get these kind of geopolitical events, more often than not, energy is going to be the right place to be. And fortunately, natural gas, especially so, seems to be the case. So. Okay, well, I think we're gonna wrap it up there. I appreciate the questions. I appreciate everybody's interest. I'm sure everybody here knows we write a blog. That's kind of how you got on here anyway. Sorry. That's how everybody got on here anyway. So sign up for the blog if you're not getting it. If you have any questions afterwards, just reach out and call us. And great to see everybody on the call. And I'll sure be speaking to many of you in due course. So thank you.
Thank you.